Home prices and mortgage rates are at unsustainably high levels, leaving the housing market in an unbalanced state that can't last forever. In today's video, we're going to look at what it would take for the housing market to get back to a more historically healthy state and what home prices would look like if that happened. Let's get into it. In my recent videos, I've highlighted the affordability challenge that home buyers are facing in today's housing market. As of December, the average housing payment as a percent of median household income was at 40%, well above the 30% threshold where the government considers a household to be cost burdened. We know the housing market can't stay like this forever. It's just too out of balance. Recent developments in the bond market suggest that mortgage rates aren't coming down anytime soon. So the only way for the market to get back into balance is if home prices come down. But this begs the question, how much would home prices need to come down in order for my affordability metric to get back down to 30%? To find this out requires a bit of arithmetic, but nothing too fancy. My affordability metric is simply calculated as an annual housing payment, which is just a function of home prices and mortgage rates, and then divide that by annual median household income. Assuming the mortgage rate and income don't change, it's just a matter of finding out what home price will move this percent down to 30%. As of December, the median home price was $441,000. If income and mortgage rates stayed the same in this calculation, it would take a home price of $330,000 in order for the average housing payment as a percent of median household income to reach 30%. That's a 25% decrease in home prices that would be needed to get this housing market back into balance if mortgage rates stayed the same. Is that a market crash? It's pretty close to it. Back in the last housing bubble, home prices declined by about 30%. So yeah, it would pretty much take a housing crash to get affordability back to some historically reasonable level if mortgage rates don't come down. Let's look at it another way. What if things changed in the economy in such a way that mortgage rates did come down? How far would they need to come down if prices stayed the same? Again, it's just another calculation. In order for the average housing payment as a percent of median household income to reach 30% and home prices stayed where they were today, mortgage rates would have to come down to 3.75%. The average 30-year fixed-rate mortgage is at about 6.85% right now, so that would be a tall order for rates to come down that much. For mortgage rates to come down that low again, we would likely need to be in the midst of an economic recession, and the Federal Reserve would need to lower their Fed funds rate close to zero again. All this has been a bit of a thought experiment, but it just goes to show you how out of balance the current housing market is right now. New data from Redfin has come in for January prices, supply and demand, so I'll be providing an update on the current state of the housing market in my next video. Some of the cracks that have been forming are widening a bit, but we're not in the midst of a housing crash yet by any stretch of the imagination. If you don't want to miss that video when it comes out, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss that video when it comes out. And if you can do me a favor and hit that like button on your way out to support the channel, it would be greatly appreciated. Thanks for stopping by. I'll see you in the next video.